For decades, the US dollar has been treated as the untouchable king of global finance. The world didn't just use the dollar, it trusted the dollar. It trusted that no matter how chaotic things got, the greenback would always be the safest place to store value. But trust isn't titanium, and it isn't bulletproof. It can be shaken, it can be tested, and in the last few years we've seen cracks forming in it. Behind the scenes, while everyone was busy watching stock charts, crypto pumps, and interest rate headlines, China was quietly building something far more serious. A wall of gold. Not metaphorical gold, real physical gold by the ton. The kind of gold you can't print, you can't sanction, and you can't freeze. The kind of gold that central banks turn to when they sense a shift. Now, to understand why gold is suddenly back at the center of the world's attention, we need to go back to something simple, something ancient in finance. The world trusted the dollar because it rested on two pillars, fee sec. As long as those two pillars stood, the dollar wasn't just a currency. It was the foundation of the global economy. But trust doesn't last forever. It's not a commodity you can store in a vault. It's fragile, it's emotional, and it can collapse in a single moment. That moment came in 2022, when the world watched a major nation have a large portion of its overseas assets frozen. No need to take political sides here. We're looking strictly from an economic perspective. And economically, that event sent a shockwave through every central bank, because the question that echoed in every capital city wasn't who's right or wrong. The real question was, if it could happen to them, could it happen to us? That simple question changed everything. Countries that had held their reserves in dollars for decades started reconsidering. Not abandoning the dollar, no, but diversifying, rebalancing, building safety nets. Because if your national reserves can be affected by geopolitics, then you don't truly control them. And what asset has existed for 5,000 years, outside politics, outside borders, outside the reach of any single government? Gold. Not bonds, not digital coins, not a fancy financial instrument created last week, just gold. Dense, heavy, physical gold. And this is where China enters the story. China is the world's second largest economy. It depends heavily on global energy imports. It dominates global manufacturing. And it holds one of the largest pools of foreign reserves on Earth. But there's one thing Beijing has wanted for years: to reduce its reliance on the US dollar. Not because the dollar is weak, but because dependence on any single system, especially one controlled by a potential rival, is a strategic vulnerability. So what did China do? They started buying gold quietly, consistently, aggressively. Officially, China claims to hold around 2,400 tons of gold. But independent research groups estimate the real figure could be 4,000, 5,000, even above 6,000 tons if you include the gold held by state-owned banks and government-linked institutions. China isn't just stacking gold, they're absorbing it, month after month, often without any public explanation. And it's not just the government. Chinese households have been buying record amounts of gold. Gold bars, gold coins, gold jewelry, anything that can be stored, hidden, or passed down. In a country where real estate has slowed and the stock market has struggled, gold has become the quiet winner, because the Chinese people understand something simple. When uncertainty rises, gold rises with it. But let's zoom out. China isn't alone. Since 2022, central banks around the world, Turkey, India, Poland, Kazakhstan, Singapore, have all been buying gold at levels we haven't seen since the 1960s. This isn't random. This isn't temporary. This is a coordinated shift in global strategy. Meanwhile, the dollar's share of global reserves has been declining. In 2000, USD made up 71% of global reserves. Today, that number is closer to 55%. Some analysts even argue that when you account for gold held by central banks, the real influence of the dollar may have already dropped below 50%. Not because the dollar is collapsing, far from it, But because the world is preparing for a more diversified monetary system where the dollar is still strong, just not the only pillar holding up the sky. And this brings us to the most important point. China isn't simply buying gold. They're building an alternative financial ecosystem, a system that doesn't depend on the US dollar, SWIFT, or Western-controlled institutions. A system built on three elements. The CIPS payment network, their alternative to SWIFT. Trade deals settled directly in Yuan, especially in energy. A growing gold infrastructure centered in Shanghai, Hong Kong, Singapore, and Dubai. This is not a short-term move. This is not a market trade. This is a long-term structural shift, the kind that reshapes financial history. When a small country buys gold, it's just diversification. When China buys gold and keeps buying it month after month, that's strategy. And strategy always signals one thing: something bigger is coming. But here's the twist most people miss. China isn't just building a gold reserve. They're building an entire gold-based architecture designed to support their currency in ways the dollar hasn't faced before. It's subtle, quiet, but incredibly powerful. Let's go deeper. For more than half a century, the US dollar dominated the world because it had something no other currency could match: oil. The petrodollar system meant that if you wanted energy, you needed dollars. It didn't matter if you were in Asia, Europe, Africa, or the Middle East. Energy ran on USD. And since modern economies run on energy, the world ran on USD too. But energy politics are changing, and China has spent the last decade preparing for that change. They've signed long-term energy deals with countries like Russia, Saudi Arabia, Iran, Brazil, and others. Deals that allow payments outside the US dollar, some in euros, some in yuan, and some in direct swaps backed by commodities. This is where gold becomes more than a safe haven. It becomes a guarantee. Imagine you're a country selling oil to China. You don't fully trust the yuan. You don't want to depend on the dollar. But China offers settlement through a system backed by real physical gold. Suddenly, the deal looks a lot more attractive. This is why China built the Shanghai Gold Exchange, a marketplace for real physical gold that clears more volume than any Western exchange. In Western markets, gold is mostly paper gold traded through futures and ETFs. In China, it's the opposite. Physical, fully allocated, audited gold. You can touch it, you can store it, you can ship it. That matters. Because in global finance, paper promises are everywhere. But physical gold? That hits different. Now combine this with China's payment network, CIPS. Think of it as SWIFT's quieter competitor. Not as big, not as fast, but growing year by year. And unlike SWIFT, it can't be cut off by sanctions from Washington or Brussels. This gives China something they've never had before: a parallel lane in the global financial highway. Not replacing the dollar, not overthrowing the existing system, just creating a plan B. And any superpower with strategic thinking will always build a plan B. Meanwhile, China continues quietly reducing its exposure to US treasuries. In 2013, they held over $1.3 trillion worth of US government debt. Today, they've cut that down to around $770 billion, almost half. Where did the money go? Into infrastructure, into commodities, into critical supply chains, into strategic reserves, and yes, into gold. Here's the pattern: less paper, more metal, less exposure, more independence. It's the opposite of what most Western economies do, which rely heavily on financial engineering and debt-driven growth. China's approach is older, more fundamental. It resembles what countries did before the 1970s, when gold still anchored the world's money. Now let's talk about the global picture. Central banks aren't stupid. They see inflation staying higher than expected. They see geopolitical tensions rising. They see financial systems becoming more weaponized. So what do? They buy gold, a lot of gold. In 2022 and 2023, central banks bought more gold than in any year since records began, and China was the single largest buyer. This isn't some random coincidence. This is preparation. Preparation for what? A world where money doesn't operate the way it used to. A world where the dollar is still strong, but not surrounded by silence. A world where the global monetary system looks less like a pyramid and more like a network. Now let's bring the story back to China. China understands that to become a real global power, you can't just produce goods. You can't just have a large army. You need monetary influence. You need a currency that other nations willingly hold. You need trust. But trust doesn't come from speeches, it comes from collateral. And gold is the oldest collateral humanity has ever used. China doesn't want to return to the gold standard. No country does. It's too rigid for modern economies. But what China wants is something more subtle, a currency that can quietly whisper, "Behind me, there is something real." Not officially, not publicly, but structurally. That's how you build confidence without announcing it. Now here's where the story gets even more interesting. China isn't trying to replace the dollar. That's a misunderstanding. What they're trying to do is reduce their vulnerability to the dollar. Because whoever controls your money controls your future. China has watched what happened to countries that depended too heavily on one system. And they decided they would not be next. So they built their own parallel system. Gold-backed liquidity, Yuan settlement channels, commodity trade routes, energy deals outside USD, digitalized gold tokens, and a massive domestic gold ecosystem. This is how long-term strategies are built. Quietly, patiently, relentlessly. But as China moves, the world shifts. Foreign investors start asking questions. Economists start running new models. Central banks start rebalancing. Countries start negotiating currencies in new ways. And suddenly, the global financial map doesn't look like the one we grew up with. Here's the reality. The dollar is not collapsing. China is not taking over tomorrow. But the global system is becoming multipolar, with more than one center of gravity. And whenever the world becomes multipolar, one asset always rises in importance: gold. Because gold doesn't take sides. Gold isn't American, Chinese, European, or Russian. Gold has no ideology. Gold doesn't default. Gold doesn't need a central bank. It simply exists. And in a world moving back toward uncertainty, that existence becomes extremely valuable. If this trend continues, we're not heading toward a new world order. We're heading toward a new financial architecture, where gold sits quietly in the background, anchoring trust, while the dollar and yuan compete, cooperate, and reshape the 21st century. But here's the question the world is quietly debating. What happens if gold keeps flowing into China at this pace? Well, the answer isn't a dramatic Hollywood moment where the dollar collapses overnight. That's not how global finance works. Currencies don't fall because someone declares it. They fall, or lose influence, because the underlying system slowly shifts around them. And that slow shift is happening right now. Picture a world 10 years from today. Energy deals between Asia and the Middle East are no longer settled 100% in dollars. African nations borrow from China using commodity-backed contracts. BRICS countries hold more of their reserves in gold and fewer in US treasuries. Companies raise capital in yuan, not just dollars. And behind the scenes, the Shanghai Gold Exchange acts like a quiet backbone for trade settlement. In that world, the dollar isn't gone. It's still powerful, still dominant, still the most liquid currency on Earth. But it's no longer the only game in town. Instead of a single global currency, we get a three-pillar system. The dollar, the king of liquidity; the yuan, the king of commodities and trade; and gold, the king of trust. Each one plays a different role. Each one balances the others. Each one represents a different philosophy of money. And here's the surprising part. The US knows this. Washington has quietly repatriated gold from overseas vaults. The Federal Reserve has been studying CBDCs. Treasury officials are adjusting strategies for a world with multiple reserve currencies. Because even America understands money is influence, not identity. And influence only lasts if you adapt. So what does this mean for the average investor? For the average worker? For countries like Vietnam, Indonesia, Brazil, South Africa, nations caught between the two giants, it means you're living through a once-in-a-century financial transition. One that will reshape interest rates, commodity prices, inflation cycles, and even geopolitics. When the world moves from a single monetary center to multiple ones, everything becomes more volatile, but also more balanced. Opportunities expand, risk spreads out, and old assumptions break. And at the center of this shift, quietly, silently, patiently sits gold. Gold isn't the future because it's shiny. Gold is the future because it's neutral. Because it outlasts every political cycle, every financial rulebook, every crisis, every empire. It was here before the dollar. It will be here long after us. And right now, China is betting big on that fact. The real question isn't whether China wants to challenge the dollar. The real question is whether the world is ready for a monetary system where no single country holds all the cards. Because once that system emerges, it won't go back. And that brings us to the final thought. The thought I want you to sit with. If gold becomes the silent foundation of a new global financial era, who actually benefits the most? The United States? China? Or the countries that learn to play between them? Let me know your thoughts in the comments. This story is far from over. In fact, it's only just beginning.